Hello everyone, welcome back to Pocket CFO. I'm your Pocket Chief Financial Officer. Lately, my inbox has been flooded with anxious messages from subscribers asking, Futu, Tiger, and Longbridge are under investigation. What happens to my US and Hong Kong stock accounts? Can I even invest in overseas assets anymore? On May 22, 2026, the China Securities Regulatory Commission, or CSRC, alongside 8 other government departments, launched a massive joint crackdown, signaling the absolute end of the gray area era for cross-border stock trading. Today, I'm skipping the fluff. As a financial executive, I will break down 3 crucial things in just 9 minutes. First, how you must handle your existing accounts right now. Second, the 5 fully compliant pathways left for going global. And third, a comprehensive cost and tax comparison matrix to help you avoid the wealth-draining traps of pseudo-compliant channels. This is high-value data, so make sure to like and subscribe. Let's dive straight into the core details. Part 1. The regulatory crackdown. What happens to existing assets? The scale of this enforcement is unprecedented. Futu faces proposed penalties of roughly 1.85 billion RMB. Tiger has been fined over 300 million RMB, and Longbridge has received a formal administrative penalty advance notice. Why? Because under Chinese securities law, any institution providing brokerage services to domestic residents without a local domestic license is strictly conducting unauthorized operations. In short, they've been driving without a license. So if you already have an account, is your money just going to vanish? Let me be crystal clear. Your capital is safe, but your countdown to exit has officially begun. The regulators have laid out a strict 2-year consolidation window. During this period, these platforms will operate on a liquidate-only model. You cannot buy new shares and you cannot deposit new funds. You are only permitted to sell down positions and withdraw cash. Once this 2-year period wraps up, these offshore brokers will fully shut down their domestic websites, trading apps, and localized servers. My actionable advice: do not procrastinate. Utilize this 2-year window to systematically wind down your positions and execute an orderly withdrawal. Part 2. The 5 compliant pathways. Which route works for you? Now that the gray markets are closed, how do we move forward on the legal high road? Route 1. QDII funds. This has the lowest barrier to entry. You can start with as little as 1 RMB directly via platforms like Allocation or traditional banking apps. However, its fatal flaw is the chronic shortage of foreign exchange quotas. The moment the quotas run out, off-market subscriptions are capped or halted. If you try to bypass this by buying on-exchange QDII ETFs in the secondary market, beware. Many of these cross-border ETFs are trading at a premium rate exceeding 5%, and historically, these premiums have spiked up to 40%. Buying at a massive premium makes you an easy target. Even if the underlying asset appreciates, you will still lose money the moment the premium normalizes. Route 2. Stock Connect, southbound. This allows you to use your standard domestic A-share account to directly trade over 500 eligible Hong Kong stocks, including tech giants like Tencent and Alibaba. The capital flows within a closed loop inside the country, completely bypassing QDII quota restrictions. However, it comes with 2 steep hurdles. First, your average daily financial assets must not fall below 500,000 RMB. Second, its dividend tax rate sits at a flat 20%. Which is practically double what you'd pay opening an account directly in Hong Kong, making it highly inefficient for long-term high dividend yield strategies. Route 3. Southbound ETF Connect. This is what I call the hidden ace that many investors completely overlook. It shares the same 500,000 RMB threshold as the Stock Connect, but it has expanded significantly. You can now use RMB to buy Hong Kong-listed ETFs that track US, Japanese, and Australian indices. It completely dodges the quota limitations and premium risks of domestic QDII funds, supports T+0 intraday trading, and is currently the single most efficient legal bridge for global index allocation. Route 4. Mutual Recognition of Funds, MRF. This allows you to purchase Hong Kong domiciled funds managed by elite global asset managers through authorized domestic channels. It operates independently of QDII quotas, offers higher reporting transparency, and frequently provides currency-hedged share classes to lock in exchange rate risks. Route 5. Cross-bounded Wealth Management Connect. Exclusive to residents of the Greater Bay Area, this route requires a minimum investment asset of 1 million RMB. However, it is strictly capped at fixed income and wealth management products offered by authorized banks in Hong Kong and Macau, No individual equities allowed. It is purely an income-oriented play. Lastly, physically traveling to Hong Kong to open a local bank and brokerage account remains perfectly legal. However, you are still bound by the strict annual personal foreign exchange limit of $50,000, making ongoing funding highly tedious. Part 3. The hardcore breakdown: cost versus tax matrix. As a seasoned financial executive, I always tell business owners, never look at gross returns in a vacuum. You must evaluate the all-in execution cost and the tax friction. Take a look at the matrix on your screen. Transaction fees. When trading individual equities through Stock Connect, you face a 0.1% stamp duty on both sides. In contrast, Southbound ETF Connect currently enjoys a temporary exemption. The silent killer: dividend tax friction. If you purchase Hong Kong stocks via Stock Connect, domestic tax authorities impose a flat 20% individual income tax on all dividends, auto-deducted at the source. However, if you hold those exact same shares via a direct local Hong Kong brokerage account, the dividend withholding tax on most red chip and pure Hong Kong enterprises is often 0%. Let me illustrate this with a simple case study. Suppose you invest in a Hong Kong stock with a robust annual dividend yield of 8%. Via Stock Connect, after the 20% tax bite, your net take-home yield drops to 6.4%. Via a direct Hong Kong account, you keep the full 8%. The exact same asset, under the exact same corporate dividend policy, yields a 1.6% annualized performance gap. Over a long horizon, this compounding difference is the fine line between true wealth generation and underperformance. Part 4. Strategic Action Plan. How should you position yourself? Having analyzed the data, how should you deploy your capital based on your net worth? Here are 3 highly pragmatic blueprints. For portfolios under 500,000 RMB, stick strictly to off-market QDII funds or mutual recognition funds, MRF. Your golden rule: always subscribe at the fund's actual net asset value, NAV, and never overpay for high-premium on-exchange ETFs. For portfolios above 500,000 RMB, immediately activate your Stock Connect. Use it to tactically hold core blue-chip Hong Kong equities and seamlessly pair it with the Southbound ETF Connect to channel RMB directly into tracking the Nasdaq 100 or S&P 500 without quota ceilings. For high-net-worth investors with long-term global allocation needs, it is well worth evaluating a physical account setup in Hong Kong. While you will have to systematically manage the annual $50,000 remittance limit, it grants you unfiltered global market access and optimal dividend tax structures. This regulatory cleanup isn't designed to lock down your capital. It's a structural reset to force the industry into a regulated, safer, and highly compliant framework. The Wild West era of cross-border trading is officially over, but the era of sophisticated, compliant global asset allocation has just begun. I have compiled the comprehensive, high-resolution global asset allocation cost matrix you saw on screen into an exclusive PDF. If you want a copy, drop a comment below or send me a direct message and my team will share it with you for free. If you're currently navigating the unwinding of a Futu or Tiger account and have questions, leave your thoughts below. Don't forget to subscribe to Pocket CFO and hit that notification bell. Our mission here remains incredibly simple: helping cross-border entrepreneurs and global investors see through the noise, and making sure finance and tax are always spoken clearly. I'll see you in the next video. Pocket CFO, finance spoken clearly.